The Morningstar categories of non-traditional unconstrained bond cover a very wide range of investment goals and styles. And so we think it's important that investors understand what the goal and what the style of each individual fund is. We tend to look at these in three sort of buckets or ranges. The more traditional funds are invested in all of the usual global bond asset classes, but generally very few limitations on the allocation to any one of those classes. But they're going to be long only. They're going to be very much your traditional kind of core plus funds with very little constraint. In the middle, we have funds that are still primarily long only, but will have much more diversification or management of the duration of the portfolio, usually through short treasuries, but still are going to be primarily long only in all of the same bond classes as the traditional funds. And finally, we have the hedge fund or more liquid alt type strategies. They're going to be very complex, a lot of long short. They're going to be very absolute return oriented, that is T-bills plus some rate, and they're going to be very uncorrelated with any of the other asset classes out there, and so need to be treated accordingly. Well, sticking with the three bucket component that we set forth, the more traditional funds are going to be used either as a full replacement for a core bond allocation for very aggressive clients, or as a heavily weighted component that allows that part of the portfolio to maximize returns while keeping volatility roughly in the same range. The more moderate bucket in the middle, where there's more duration management, is going to be used as more of a satellite allocation and used to control interest rate risk as opposed to maximizing returns. And the more complex hedge fund and liquid alt type strategies are going to do both. They're going to provide broad diversification because they're not going to be correlated to any other asset classes. They're also going to reduce the income or interest rate exposure, but they're going to have reduced income. And so those tend to be very small allocations within a portfolio. I think the most important thing is to set the right expectations. These funds aren't a cure-all for any portfolio. The reduced interest rate sensitivity comes at the cost of lower income and usually higher expenses. A lot of the funds have very short track records. Virtually all of these come from 2010 forward. Even if they have longer track records, their investment mandates were changed post-2010, and so the risk-reward profiles changed dramatically. And finally, while many of the funds put up very good returns in 2011, that was simply a function of the credit environment coming out of the post-financial crisis period, and isn't something that we would expect going forward. And those return expectations need to be modified substantially.